Duolingo shares have experienced a volatile swing here in 2025 as investors are concerned with substitute technology that's coming out that's reducing demand for language learning. In this video, I'll update my buy or sell rating on Duolingo stock given the recent change in valuation. So Duolingo stock has really been on a roller coaster ride here in 2025, jumping to 450 right out of the gate, then dropping down to 275, then soaring to 550 before crashing down to 275, and now recovering to 338. Year to date, it's up 4%, but investors are nauseous after the ups and downs throughout this year. Longer term, Duolingo has done an excellent job in increasing its customers and increasing customer engagement. The company's revenue has increased from 71 million in 2019 up to 885 million in the most recent trailing 12-month period. That's good for an excellent compounded annual growth rate of 58.3% in that time. However, investors are concerned with the growing substitute technology, things like on your phone you can translate, Google Translate, and headphones that can translate while you're talking, reduces demand for language learning. And so investors are concerned that the company will not be able to sustain this kind of growth rate for the next 5 years. How much will that growth rate slow down? That's the risk right now with Duolingo stock investors. Impressively, as the company has increased its revenue, the return on invested capital has also improved from negative 54% all the way up to 15%. The company is already exceeding its weighted average cost of capital with the return on invested capital, and that means it's adding to shareholder wealth. Again, those questions remain. If the company's revenue growth slows down, will the return on invested capital also suffer as a result? Now, Duolingo stock has a mixed valuation. When I look at it on a forward price to earnings basis, it looks as expensive at a forward PE of 88. When I look at the forward price to operating cash flow of 33, it looks fairly valued according to that valuation metric. Duolingo uses a significant percentage of stock-based compensation. That's a non-cash expense. That goes to reduce its earnings, but it doesn't hurt the cash flow. And let me clarify that a little bit. So when a company pays its employees in stock-based compensation, it has to recognize that as an expense on the income statement. But it's not a cash expense. It's not giving the employees cash. It's giving them stock-based compensation. Click the link below to watch the full video.